Welcome, members and guests. This is Hanny Michael, and welcome to our monthly meeting. We are a Better Investing Model Club, open to the public. All of our meetings and stock studies are virtual, allowing us to have members from the US and around the world, including Canada and China. All our guests today, you're currently muted. You'll be observers, and but you will have an opportunity for questions and comments once the meeting ends. We're going to ask you to give us your feedback on how the meeting went. We're always trying to improve. I would like to mention that any companies that we present today are for educational purposes only and are not to be intended as a recommendation for buying or selling any stocks. We ask that you conduct your own review and analysis of any company that you're interested in before making an investment decision. And this meeting may mention products or services that are not endorsed by Better Investing or the club. The views expressed today are those of our members and don't necessarily represent those of Better Investing. You should also know that this meeting is being recorded and will be posted to our YouTube channel for future use. So with that out of the way, I will pass it on to Matt to go through the agenda. Matt.
All right, so just looking at the agenda, Haney did the disclaimer, so we are 3 minutes ahead of time right now. Then we're going to do the treasurer's report. I believe Tom does that. Then we're going to go straight into the stock study with Tom and John on the residential home building industry. We moved that up. And then we're going to do the two reports. So the annual report from HICO, from Joanne, and then the quarterly report from Five Below from Haney. We can talk about any buy or sell actions we want to take for 15 minutes. And then if we still have time, we'll do an education topic on discounted cash flow. And if not, we'll just move that to next meeting. So that's the agenda for tonight. Any questions?
No.
All right, let's go. So with that, treasurer's report.
Okay. These are the holdings.
Hold on. I'll make you a presenter. I'm sorry, I'm behind. Oh, there you go. Okay.
Okay. I guess I need to show my screen.
Yes.
These are the holdings. You know, and it shows. I guess that's showing the. This one says the EPS growth rate. Whoa, I guess I didn't. This is weird. I didn't look at this. Air Lease is projected to go down by 28%. That's not good. I don't know how old these things are. Five Below is up at 23.1, but they just had a really shaky earnings report. So I don't know what to think about this.
I think, Tom, if you look at the top, it says report as of 11/7/2019. So what you have
that's what we're projecting.
Yeah, and you have to do a valuation each month. So if you go to the left-hand side where it says valuation statement and click that, and then choose from valuation dates, and then click that down button. And I guess you can't. Okay. I used to be able to make it more recent, but it's doing a valuation from November, which is kind of it's a bit late. Create new valuation. Yeah, sorry, that's it. And then just submit. That's fine.
So this is this. You know, I guess it's under reports.
Or do do a gain loss report at the bottom of under portfolio gain loss. Yeah, right on the left there. Keep going. Yeah, one more.
There you go.
And
This is
report
better. I
date
think this is
120.
what we want.
Yeah, submit. Do a submit, just in case to refresh it.
And it doesn't seem to be doing, it doesn't look like it's doing anything.
Okay, so that's probably, yeah, it says it's already done it. So it says
It's
as
hard,
of
doesn't it?
Oh,
120.
report generated as of, okay.
Yeah.
They're using East Coast time, okay. So these are the returns that we have.
I wish they could sort, you know. Are these
Yeah.
yeah, I wish they can.
You
Yeah.
can't, unfortunately, but like you can see, Heiko is the best performer at 183%, 184%, and then 5 below is the next one after that, and then Lamb Research. Those
As you
are the
can see,
three big ones.
there's no loss. All gain. The least gain is public storage, which we wanted to sell. We have not sell yet.
Because
Everything's
I
down.
thought we sold that. Didn't we sell public?
You know, I don't remember. Maybe we did. Maybe I should have sold it.
Yeah, because I'm not tracking that anymore. I thought we agreed to sell that.
Well, we can sell it very easily because
Yeah.
we can go back on Yahoo Finance. It has the historical prices, so we usually sell the next day after the meeting.
Right.
So if we know which meeting we decided to sell it at, we'll just go in and do that, and it'll.
So which meeting was it sold at?
We need to. Was
We
the
can
last
check
meeting or
that.
the meeting before? Either October, or November, I think.
It wasn't December?
No.
December was education topic, and I don't believe we made any.
It's when we last presented public. I'll tell you, Tom. It's when
Okay.
I last presented the quarterly report.
Okay, thank you.
Okay.
We can go back and we'll figure it out.
Yeah.
I can help you out, Tom, after the thing, but.
But looking at this, it's not that bad.
No, but the market has gone up quite a bit
Right.
recently, right? So some of these were not doing so well, and then because of the recent market, takeoff, we're doing pretty good at the moment.
This kind of market makes everybody feel like better investors than they really are.
Okay, so I have a question, Hanny and Tom. So the total percent gain loss at the bottom, 43.1%. What is that? Is that just for when we purchased it? And is that considered the rate of return?
So it's yes, but each one of these was purchased on a different date.
Right.
Okay. So whenever and some of them were purchased more than once. So for example, if you look at the second one, well, that's not quite true. I was going to say that if you look at Disney, for example, Disney is one that I remember. We purchased 2 or 3 times, and each time we purchase $1,000. So Disney is at 4,000. But Algonquin Power, I think we decided one month to buy $2,000 worth. But anyways, it doesn't matter. You can see the date first purchased. And in the case of, say, Disney, that's the very first time that we bought $1,000 worth of Disney. It's not. There were other times where we added to our position. So what this program does is it calculates for the first tranche of stocks that we bought at $1,000. It works out what the gain is, and then it adds the next tranche of stocks at a different time that it was purchased and till today, till that valuation date of 120, and so on and so forth for each of those companies. And so that 43% is basically the overall but it's not an annualized return. That's a total return.
Yeah, it's the difference. It's 31%, the difference between the cost and the market value.
Right.
So
So
you know,
we bought $33,000 at the bottom worth of stock at various times, and that 33,000 is now 47,000. So we made 15 or 14,375, which is 43%. But it's deceiving because that's not an annualized rate of return. And I worked that out in a spreadsheet once. It's a bit of a complicated calculation, but we can do it.
Okay. All right.
Does that make
Thank you.
sense?
Yeah, I'd like to see the annualized, but I guess they don't calculate that. Because that's what we do our projections on.
Right.
Yeah. Okay, thank you.
and annualized can be confusing too, because if you have something that goes up 10% after 6 months, your annualized return is 20%, even though it only went up 10%.
Okay.
So this is what we have, and we can go sector and industry. We've got some consumer cyclical, financial, got public storage, got the utility, communications. We've got quite a few different sectors, not all. And if we look at size, I guess we don't have any small caps at this point. We've got mid cap, large, and mega. Is that bell? I mean, time's up.
No, you've
No,
got
that's my phone going off in the background. Sorry.
Okay.
you've got 3 minutes, Tom.
Okay. Well, I don't really have anything else to
Okay.
present unless somebody has a question.
Well, great.
I
Thank
guess,
you.
Tom, if you present the two companies you and John are going to present, they are small companies.
Well, one is small. The other one
One's
is I don't know what Lennar is. I know LGIH is small. I don't know the size of Lennar.
Let me
Sorry.
look the sales.
Okay. So do you want to start with your stock study presentation then, Tom?
Sure.
Okay.
Okay. So I guess I still have the screen.
Yes.
Okay. So I did myself here. I made a little a few slide PowerPoint presentation. Residential housing, and it's a cyclical industry, and it's affected by employment, and more people with jobs can buy more houses. Consumer confidence, people will buy more houses when they're feeling confident. And mortgage rates, if mortgage rates are low, people can afford houses are more affordable because everybody buys them on time. So how do I get rid of this thing now? If I X this, do I? Well, I'll put this over here.
X what?
Well, I was going to put X this little panel here. Will it log me out?
Oh, you don't want to X out. It's
do the red arrow or the orange
red arrow.
to
Okay.
shrink it.
Okay, good. So anyway, this is the unemployment rate. The unemployment rate is about 3.5% now. It's the lowest rate in 50 years. It was a little bit lower back in the 1950s, but it goes up and down. You can see over here, it's been coming down since 2010, last 10 years. Consumer confidence remains high. It's not at its highest level, but it's been going up since 2009. It was a little higher before the dot-com crash, but it's still at a very high level. Mortgage rates are low. This is pretty current here. 30-year fixed is a little over 3.5. 15 years about 3%, and this adjustable 5-1 means it's 3.39 for 5 years, and then it can adjust once a year after that. So you can see this, the mortgage rates have been coming down. They're up a little bit, like 6 months ago or so they were higher, but they're down now since the Fed lowered rates. And housing starts have gone up a lot. You can see on the graph here just recently, the housing starts are up number. So I don't know how important all these numbers are, but certainly the trend is positive. And this is an index of the confidence. I guess they poll the National Association of Home Builders, how confident they are in the market, and it looks like it's pretty much in an all-time high. So there's a lot of tailwinds for this industry. Now, okay, so I guess don't need that anymore. Get rid of my iClub. And let's see here what I can do.
By the way, Tom, did you get a new microphone? Because you sound a lot clearer than last time.
Well, last time I'm on my headset. Last time I had my headset plugged in, but for whatever reason, I wasn't given the choice of picking the headset as my microphone. So I just had my computer mic. So now today it let me, I don't know what happened, but today my headset is working. So.
Well, it sounds a lot better.
Okay. So anyway, I chose Lennar, which is one of the two biggest, it's now the biggest actually by a little bit, home builder in the United States. When I started looking at it, it was, considered by many people to be undervalued somewhat. And so I thought, they're successful and a strong person, or a strong company. So I thought I would chose them. And they released earnings on January 8th. So on January 7th, the share price was 57, and at the latest price is 63. So it went up $6 in that period of time, which is good if you hold it, but it's not so good if you're thinking about buying it. So I chose them. Here's the reasons. There's some information about them. They're the largest home builder in the United States. They operate in 79 markets in 21 states. They have a lot of communities, they call them, in the Sacramento area. They have Elk Grove, Woodland, El Dorado Hills, and other places around Sacramento. Their sales growth has been over 26% over the last 5 years. Earnings have grown at 15%. Pre-tax profit has grown at 21%. With the latest earnings, their total revenue grew by 8%, which is less than the 26.4 over the last 5 years. The number over the last year, the number of homes sold increased by 16%, but the average sale price was down by 7% because they are now emphasizing entry-level homes, which is the fastest growing segment of the housing market. Their philosophy is they call their trademark everything's included. They have like upgraded floors and countertops, things like that. That they're able to, if they put all these items in all the houses, they can do it at a lower cost than having people, specify all these things. So they have their everything's included motto or whatever sales pitch. They also can provide mortgage financing. I think they don't have this in all the markets, but they provide mortgages in about 80% of the markets where they sell houses. So customers can come and look at a house, and if they want to buy it, they'll just, it's like at the car dealer. They can finance it right there. I don't know if it's that quick, but it might be, because they're putting in a lot of computerizing their mortgage process. Their new orders grew by 23% year over year. They have a fairly large backlog, which is 15,500 homes. And their guidance for next year is 54 to 55,000. So, well, I guess maybe about a quarter of the homes are, of next year's sales have already been sold. They cut their doing things what they can to cut expenses. So they've cut the staff in the mortgage division by half with automation, and they're targeting right now what they targeting the option to lot to total lot ratio, which, I guess like right now they own about 2/3 of the lots, and then they have options to purchase the rest. And that ties up more money. So for next year, they're targeting 50%, where they're going to have options on 50% and own 50%. So I don't know if maybe I did that backwards, but I guess
what does that mean, option a lot?
Well, currently,
no, I think you said it right, though. I think you said it right.
Well, currently they own 67% of the lots, and they have options on 33%. They enter in a contract, they pay somebody, say, we'll give you $1,000 for the option to buy this lot within the next 5 years or something like that. Rather than entering into a purchase agreement and financing it or whatever to buy that lot outright. So, and I guess they probably agree to a price or whatever. So they have a lot less money. They're going to tie up less money. They're going to have, it's going to decrease their debt, their operating costs to have more lots optioned rather than more lots owned. So it's more of a capital allocation thing, really. And they're paying down debt and repurchasing their shares. So I don't know, here's this historical growth rate. Some of these things, look positive, and there's some other ones like, some just seem like really weird. I mean, like the industry, I can't believe its earnings per share is up 85%, and pre-tax profit being up over 450%. It's just, there's something strange.
It depends, Tom, on if you have a very small group of companies that they're being compared to in the industry, if they're the largest by far, then that might make more sense, because
well, it just both of those numbers are just I don't, but
they're high.
They're well, they seem like outliers. I guess mathematically, I guess it's possible. And so I guess their debt to capital is about half. So anyway, I chose 6% for the sales, but I just went by the analyst estimates. There, I chose as many as I found, as many sources as I could. And so, there's kind of a range from 4% to 8.8%. And then earnings per share, I chose 8%. And again, there's a kind of like a narrower range for what analysts think. And then as far as PE, I just went pretty close to the average PEs, maybe cut them back a little bit. You can see here.
Sorry, Tom, can you make your screen bigger? Those numbers look pretty small. Okay, thank you.
Well, that still isn't very huge.
Yeah, maybe increase large your, just Control Plus to make a little bigger. Or hold down your mouse to roll.
Or I can do this too.
Oh yeah, that works too.
Okay.
Better.
Okay. So anyway, you know, the average PE is 11.9, current is 11, and I guess the average high is 14.5. I chose 14. Average low is 9.4. I chose 8 to be a little conservative. And for the last couple of years, it's been below average. And you know, with the price increase, you know, I was kind of I was disappointed to see the price go up, and I was thinking about buying some myself, but I didn't. Now I'm regretting that. But anyway,
it will come down.
The price will come back.
I think so.
Okay, so anyway, that, you know, my selected low price turned out to be 46, and I ended up with upside downside ratio of 3.3. And I guess potential appreciation, you know, it's not projected to double. But I guess the annualized appreciation is forecast average PE is 8.5%, which is certainly nothing stellar. But you know, I think they're a cyclical company. But you know, I think they're a solid company. But on the one hand, on the other hand, it's cyclical. So if mortgage rates go up or unemployment goes up or there's some kind of economic disruption, this business is going to be certainly impacted by that.
Can I see the trend of the company, the first page? So the historical growth 26%, but your forecast you only gave them 6%. I would say that was pretty conservative.
Well,
right?
but you know, I don't think they can really. Well, maybe we could boost it up to 8 or something.
No. I think that's good, conservative, because this industry is very cyclical, like you said. I'm just wondering, looking at their historical growth, which is great, but your forecast.
And I cut out, these through 2014 because the line was so much steeper down there. I don't really think it had so much effect. Now there's something. Let's see here. There's if we look at the quarterly data.
I would like to see that. Yeah, the trend.
The quarterly data, we have kind of like an outlier here, which I didn't adjust for. We have pre-tax profit. If you look here, earnings and pre-tax profit is really high here. A year ago, but that is because they had a one-time gain. They sold kind of like a real estate company that they owned, Rialto Capital Management Division, where that's a division of the company. And so that quarter, they reflected, they sold it at the end of a year ago, and I don't think they got the money until 2019, but they put it into this quarter of for tax purposes. Somehow they had to pay less taxes if it was booked in that quarter than if it was booked in the future. So anyway, it's 296 million gain, which you know, they didn't really earn it. It's because they sold something, or
Right.
58% to 58 cents per share. Now, I did another stock selection guide here where I adjusted it, but wasn't quite sure, you know, if I did that right. But oh, what is happening here? Okay. So in this case, you know, I mean, we've got earnings per share coming up. You know, this looks good here. You know, 15% earnings per share, sales up 13%. You know, year over year. Of course, the pre-tax profit, I didn't know how to adjust that. It's minus 6.7. But you know, the trends are positive, but I'm not sure this is it's not a screaming buy.
This is a large company, 22 billion in sales.
Do we want to,
Yeah.
it's 6:30. Do we want to go to the next one? And then if we have questions, we can come back to this?
Yeah. Let's
Okay.
compare the other company.
Okay.
Okay.
Thank you, Tom.
Okay, you're welcome. So I guess take it away, John.
Yeah, I'm going to make John as presenter. John, make you presenter.
Okay. All right. Okay, well, I have 15 minutes, Joanne, or probably less than that, because we want to have questions for both of these stocks, right?
Sure. I mean, yeah, try to do it in 15 minutes, but if you go over a little, it's okay.
Okay. I'll try to go, I may go under that. Just as a general discussion, Tom was very helpful. He was guiding me through this. He was very available and able to answer questions and willing to help and everything. But I just had a little struggle with the stock study with this first cut thing. Some of the questions, I read everything I think I was supposed to read, except Jay told me I should probably read the annual report, even if it's pretty old compared to the year, because it has more, not the annual report, but the 10K, because it has more information in there. But I read the 10Q, this document that Tom found. I guess you guys probably know about it, but where is it? Got so many windows now. Oh, here it is. The small cap informer, because it was LGI Homes was in there, so we discussed that. We've read that. And other stuff too, but as far as writing stuff down, if you check out my report before this meeting, before now, you can see that it's pretty short. So I did the best I could, and I'll just go over what I wrote down. So this one here, it's LGI Homes, price 71.06, and that's as of 1/5. I'm not sure where it is right now, but we could just look it up real quick. But the 3 quarters ending September, third quarter, compared to 3 quarters in 2018, in September. Home sales revenue increased slightly, or 14.2% actually. It just looks smaller because it's 1.2 to 1.1 billion. Homes closed increased by 11.1%. Pre-tax profit increased 2.8%. Return equity as of 9/29 is 22.51%. Got that from Morningstar, as well as debt to equity of 0.97 from Morningstar. Here's the things that these historical growth rates. Jay told me I should probably go 10 years with the company.
I would do 5 and 10, so do a comparison.
5 and 10.
Yeah.
Comparison. Okay.
Put the column next to each other.
Okay.
Yeah.
All right. Well, Tom
You do know in the future.
explained. Okay. Yeah. Sure. Tom explained in an email that all of these down to here could be found through the SSG, through a compare peers tool. That's what I basically derived these from. Was from there. I don't know why pre-tax profit is so crazy for the peers, but I think did Tom say that too as well for his study
Yes.
as well? Pre-tax profit.
Oh, so these are the Morningstar industry
okay.
numbers,
Okay.
right?
So
Because you guys said they're from the BI tool.
Right.
Doesn't seem like very. Yeah.
Yeah. Yes, it came from the SSG.
Yeah.
Yeah. Okay.
Uh,
This one we got from, I don't know where Tom got his, but I got this from FinViz. I looked at the peers in SSG and found those companies grouped together in this tool, the screener tool. And you can just sort by the screener, by that industry, or that drill down to the industry, sort by that, and then do the average. So it tells it to you right there on the page. I don't have that one up as one of my windows, but I can show that later if there's a question about that.
John,
This is pretty, yeah.
I have a question. Are both of yours and Tom's companies in the same industry, or are they different industries?
Same industry.
But it seemed like your numbers were different. They weren't for the industry numbers?
Good
A little
It may have been
question.
different.
They
It may have
should.
been different. I can't remember. Tom, did we calculate these, or were these just
Well,
drawn
I
up
got
and plugged
I
in?
got mine straight off the stock selection guide. If you go
Wow.
back,
Okay. Oh, for
if you go, I think is it the quarterly data or someplace valuation? I can't remember where it is, but you can.
Yeah, I was trying to find it just
Oh,
before.
okay. No, go to valuation and return.
Okay.
Yeah, I
Compare
just
pairs.
compare.
No.
No?
Someplace
Yeah.
there, someplace it says compare. Okay, here we go. Oh, you had it. You had it there.
Okay. All right.
Compare peers.
Maybe
Okay.
our people are different.
And then you click across the top there, and it shows like there's the industry average here down here,
Oh, right,
industry
yeah.
5-year average. So click to the, click to
Right.
EPS, and then the industry
Yeah.
average, and then down there in the bottom right hand corner it shows the industry average for the past
okay.
5 years.
Yeah.
That's
Right.
where you
So
get these.
we may
Oh,
have
so
slightly different
really depends
competitors.
it really depends. So these are the default peers. I don't think we should rely on those.
We can, but it says industry average. I don't know what's included in the industry, and we can change the we can
Competitors,
you can
peers.
change the up on top. You can change the peers, but I don't, you can't change the industry average. I just went with the industry
Oh,
average.
okay. So the average was not from these peers. Oh, I see. I thought.
No, Jay, there's two. There is peer group average, and then underneath is industry
Okay,
average.
gotcha.
Okay, yeah, industry average. Okay.
So the
I see
peer
what you're
group is
saying.
whatever you
Yeah.
select, whichever
Mm.
three that you pick, but
Mm-hmm.
the industry average is a default that they get. And I'm not sure, I agree, I don't know where it comes from, but it's.
Yeah.
Okay.
Well,
Thank you.
Okay. Well, anyway,
But you guys
this is
do
pretty.
have a different. I just looked at you guys' numbers. You guys are different.
Maybe I
With
picked peer,
industry
he picked
average.
industry, or vice versa, or maybe it's different.
I
Because
used
of the cap.
the industry average.
Okay.
Maybe I did it wrong, but
And maybe they're slightly different sectors or something.
Yeah, I would say. Yeah. Okay. So this is pretty basic. This is just copied from the 10Q. So they're engaged in design, construction, marketing, and sale of new homes. They're a home builder, obviously, and they have markets in various states. They're in 3 active communities as of the end of the quarter. Projected worth for, so this is where it kind of gets like, I would like a stock study or a education topic on how to answer these questions here, because like I read everything I was supposed to read and I didn't know what I was supposed to write. Honestly, I talked to Tom about it and he tried to help me, but I don't know. So sorry about that, but that's pretty much this is pretty much a lot of market stuff right here, but not so much about this company per se.
well, there's only 1 or 2 analysts who cover this company. It's a small company.
Yeah, it makes it harder to cheat and just read what other people are saying and kind of get a start on what you might think of it, because based on what someone else thinks of it. But because there's only 1 or 2 analysts covering the company that we saw, Tom and I saw. So
how did you find this company?
This is Small Cap Informer.
Okay, so you so you want to present other companies, so you're looking for the competitor, and you went to the small cap.
Well, we started. I was interested in the industry, and this, small cap informer mentioned this one positively, so we decided to go with it. And then I spent quite a bit of time thinking about, which other company in the industry. So I decided to go with a large cap that was a successful company. And where we talk about the going with the best company in the industry. And I don't know of any case where the best company in the industry is going to be a small cap. The best company in the industry is going to be this big successful company that's efficient. And I guess we can really hunt for small caps, but if we go by that definition, I don't know if we're ever gonna. The small cap it may be later on, but it's initially you can't say that.
Yeah.
John, can I say something about how to find that information?
Sure.
Sometimes you can, in their earnings calls,
Okay.
the analysts will ask those type of questions, where do they think their future growth is going to, because they're the ones that are interested in how well the companies, and plus meeting their targets. They'll have guidance on what they want to, new areas they want to go into, or the areas that they're focusing on. So those earnings calls really can be helpful in answering that question.
They sometimes they do provide guidance, but often it's only for a quarter or for the next year. They never provide long-term guidance.
Long-term, no long-term. Yeah. John, can you go back to the newsletter, the informer you were just showing? See on the middle page, in 2019, LGI Homes was recognized by Builder Magazine as the 10th largest home builder in the U.S. LGI? I thought LGI is the small company, but largest home builder. Oh,
well, 10th largest.
10th largest. So yeah, they're 9 ahead of him. Sorry. Yeah, okay.
Maybe there's a steep curve from, within the top 10. Maybe the lowest is pretty low.
Okay. Well,
you can show us the SSG because you're going through these numbers. Why don't you show us the SSG? It tells us the. Oh, he only has. Oh, never mind. Sorry, I thought it was the.
Okay.
They went public 2013.
That's what that newsletter said, right? But
yeah.
Okay. Well, they have some data from before then as well, I guess.
So it's a relatively new company.
But they grew really fast, but it was off of such a small base.
Yeah. So why did you give the 13%? You took the average of the.
No, I just thought that we go conservative, and that's pretty much the main aspect there. I forget what the newsletter said.
Just a clarification, John. So when you look at that 17.7 where it says sales 2-year estimate.
Yes.
So after 2 years, they will have grown by 17.7% according to these analysts. The number that you forecast, the 13%, you're trying to guess what the annual growth rate is going to be for each of the next 5 years. So what you're saying here is that next year they're going to grow by 13%. The following year they're going to grow by 13%. The following by 13%, and so on for 5 years in a row. And so, because this is a bit confusing, and the same with earnings. So you're trying to forecast 5 years. And there's a couple of places where you can get that number. One is Yahoo Finance, and the other is Zacks, where the analysts will make a 5-year prediction. So if you wanted to compare, and the other one is Value Line and Morningstar. So if you wanted to compare your estimate here to what other analysts are saying, you look at Value Line first, then Morningstar, and then Yahoo Finance and Zacks.
He did have a Value Line. He said John It's documented value line is 7%. Morningstar is over 4%, and seem like
We had the value line, but not
Yeah,
big
because it's a
enough.
smaller thing, value
Yeah.
doesn't cover the small caps very well. So you won't find it in
Right.
here, I guess. Yeah.
Right.
Let me
Yeah.
take a look at Zach real quick.
No, it's, well, yeah, I guess number. It says annual rates, but that's probably historical.
Well,
Zach did 15.
Yahoo is projecting sales growth of 14.8% over the next 5 years.
Zach is projecting 15%.
And I didn't know that, Hanny, about I didn't realize that. I guess I could have seen that, but I didn't realize that about the sales 2-year estimate, and this is a 1-year estimate.
Mornings.
Well, this is
no,
one
this is a
year for the next 5
year.
years. Yeah, but it's
Okay.
not 13% over the 5 years. It's 13%
Got it.
for each year.
What? Now, is that 2%? The 17%? Does that mean over the next 2 years total, or is that
Total.
annualized?
I
I
think
always
it's
thought that was
total.
annualized.
I'm not sure. I thought it was total, to be honest.
I thought it was annualized.
Because
That's
all
something
the,
we need
our other projections are annualized, and we shouldn't have to. They shouldn't give us a number that we have to cut in half.
Also, John, I've just quickly looked the Morningstar on the, if you go to SSG, it will tells you. Morningstar says forward 5 years growth forecast at 13.5. So that's earnings, right, guys? Growth forecast.
Yes.
I'm just compare with what John had on the first cut. The number did not match. I'm wondering, maybe in the future we can do education topic on that. Where to find those numbers? Because his numbers are very low on his first cut. I'm wondering, I don't know where he found those numbers. It did not match with what's shown.
Okay, so can we go back to the SSG?
Okay.
Okay, we are at 6:47, so let's
All right. Well, wrap it up, or
keep going
Oh,
back
no,
to your
going to
SSG.
the second
okay.
page.
All right.
Second page. We want to
Yeah.
go. Let's do a
Okay.
review.
Look
Okay,
at that
sure.
very quick. Look at that very quick. That.
So what, real quick?
That. The first
Debt.
page. That.
Okay.
Going down. The up. Okay.
Looks good.
Okay.
Okay.
Yeah, for a home builder, they're going to have to carry a larger amount of debt because they buy these lots and then they have to buy materials and so on and so forth.
I disagree. I disagree with the PE. I basically this took the average, right? I do feel, even including
Yeah.
Tom's, I do feel like it should trim down because the 2018 is only at 13.1. Even though
And if you take out the the PE in 2014, the 16.7, what does the average? You have to refresh your browser.
Five.
So it goes down to 10, right?
But if
actually,
this is cyclical, I mean, doesn't this represent the cyclical nature? I mean, if we just take out all the high ones, we're saying that it's, we're taking out that cyclical nature.
No, I agree. That's true. But like I'm thinking that it should be higher in the last couple of years because of the economy's been doing really well. So you would think that like that 13.1 PE should maybe be higher in last year compared to a few years ago.
Well, sometimes with these cyclicals, I think like when during bad times when the earnings go down, that makes if the share price doesn't fall correspondingly, the PE goes up. And then you
That's
have
true.
a situation where the earnings went, it went up to like $6 in 2018, and the share price didn't increase correspondingly. So that's going to bring your PE down. So, PE may not be totally reliable on the cyclicals.
Yeah, no, that's a good point.
Okay. Want me to go scroll down or?
I think can we trim down a little bit, like 13 or personally,
I have to reread.
I'd rather go lower.
Refresh.
And so the
No,
reason
John,
why you
just
Okay.
then
Yes.
click on that 175.8 box, your forecasted high price. Yeah.
Sure. Can I just
Change to the high, yeah,
change
Could be
this
like
to?
a 12,
Okay.
yeah, okay.
Oh, I think that's too low for high
I know,
PE.
but we haven't looked at the low PE yet. Let's take a look low PE. So he's also using the average. So what's the 52 weeks low is a $41, and then you are saying that did you use a calculation? Okay.
Oops, hold on.
Can we look at the trend? Just say update steady. Low PE, I want to see the trend.
So where do I go for that? Sure.
John, put in about a 57 for the low price.
Okay. Just
See what that
just
does.
write it in.
Yeah, just put 57.
Okay.
So 5.1. So what I did there was just 57 is 20% below 71. So the current, the stock closed at, the closing price was $71. And if it drops by 20%, which is not unreasonable, if we have a bit of a downturn, then you're going to be at 57.
Because it's at the upside down ratio 5-to-1, we can even lower to 30%.
John, can we update your data? It says closing price
Oh,
1224.
December.
Let's go to scroll up and go to data up at the very top. No. In the
Higher. There you go.
refresh study data at the scroll down.
Good catch. Good catch.
And then
Okay, now
create a
just
copy of this study.
just
Create a
click.
copy. Down. The third one.
No, create a copy.
Yeah. And then refresh.
Refresh. Good catch, Joanne. I didn't see that. Okay, let's see. Look at the second page. Okay. All right. Let's see.
52.
The price
See, it
went up to
down
78.
Oh, yeah. Low price 52. Okay. 78, 20% of that 80, 16 will be about 52. Will be about 52, right?
No, it'll be more. 20%. It'll be 62.
About $15. Yeah, $15.
62 because it went up, right? So it was 71 and it went up 78. So 20% from 78.
Yes, around 62.
Yeah.
Change this to 62. Change this to 62.
I will say a bit lower. Just be more.
Okay, well keep it
whatever.
at 57.
Okay.
Keep it at 57. Because that's more than 20%, and you're still at
62. Okay.
An upside downside ratio of 3-to-1.
Can we look at the whatever the back side, the quarterly?
The quarterly data.
Yeah.
Yes. So this company does not have a dividend, but the other one does. The large one does.
Scroll down.
We just want to see the trend, I think.
Okay.
What's happening with the sales?
Well, June 2019.
The pre-tax profit. What's happening?
It's easier to see on the graph, maybe.
Something
Okay.
happening in
Cool.
2019 because if you look, the high PE was significantly dropped as well. So something happened.
Yeah, the sales, I mean, the sales are going from 2014, they're dropping essentially, right? The green line, I mean, it went up a little bit in 2018, but then it's a lower low than before. So
Yeah,
it's
well,
They're getting bigger though. They're getting bigger. Is my
the graph flattens out definitely. If you just look at the front page, but yeah, it's the growth rate has slowed.
growth is fine because it's harder to grow on a bigger number. I see it.
What was that? What did you say, John?
I'm saying they're just getting bigger and bigger and bigger, so it's harder to build 100% on a bigger number.
Mm.
You know?
I mean, have maintain that growth rate.
Yeah, maintain the growth rate. Yeah.
But something happened 2019 because significant earnings per share, significant drop. Can you go down a little bit more?
Okay.
Yeah. So significant sales, pre-tax profit, earning per share, something going on. Did they say anything about 2019?
Yeah,
That
2019. Yeah.
yeah. What's
Where
going on there?
well, it was like the end of 2018. Things started going.
I want to see, curious about their stock price. What happened to 2019?
So were there community notes on this, John?
I think so. Yeah, there's a couple.
just,
Yeah, there was.
yeah.
The 52 weeks high was $87 in October 2019. Something happened in November. It dropped to $70. So wait on, did you remember read anything, John, about what happened the last quarter?
No, I didn't remember reading that in the earnings call, anything like that at least.
So you look at the last quarter on your first cut. You looked the last quarter ends was June. Sorry, not June, September. So you do not.
Yeah.
You have not seen the latest one.
Correct.
Okay. I don't know. Something happening in this company in 2019. We don't know what was going on. So can we finish the low price? Because the low price was still pretty high.
Okay, we have it's almost 7.
Can
Yeah.
we 57? So do you guys want to use, do you want to use the 52 weeks low? I don't know. I'm not sure.
Yep.
Does that look good to you guys?
Throw it in, see what happens.
We know it would change, yeah. But at least, Henny, we did not use 62 rather than 57. Right?
Yep.
So not quite, yeah, 20, more than 20%. Basically, we project that the price will drop. Even if we buy it, the price will drop more than 20% still. It is in a buy.
Well, we don't know, but we're saying if we want to be conservative, go to 52, see what happens, and it's it's 2.5 to 1 ratio.
Right.
So yeah.
Let me quickly take a look at the ZAC. Actually, I'm sorry, I apologize. The ZAC I was looking at early, the number I gave to you guys, it was not correct. I was looking at Tom's company. That's why it's all double digits. So ZAC, actually ZAC did not give projection for next 5 years because it's a small company.
Well, I think we should move on and then come back to this if we have time.
Okay, let me quickly do some Research. Yeah, go ahead.
And then you can do your
research.
Yeah.
you can do the background research while I.
Right. The company
Okay.
very small. There was no projection as far as right now I'm looking at it.
Okay. So I'm going
Yeah.
to do Heiko.
Okay.
Okay.
Do you want to make yourself present? Okay, I can do make yourself. Oh, you are.
Yeah.
Okay.
Okay. I am doing the annual report on Heiko, and I found, and Jay actually turned me on to this, is that to look for the investor presentation. So these investor presentations are super helpful, although they can be pretty late in the cycle. So, but they can give some interesting information. I know Bernard's always super interested in how much of the stock is owned by the board of directors and the management. So this gave a nice overview of, you know, when the company was founded, their compounded annual growth rate, 21% of their outstanding common stock is owned by the management. They have a ownership culture, and so I'm not going to go through the whole presentation, but I'm just going to show you some of the key areas that I thought were important for Heiko. One of them is that they have a global presence and they're pretty well diversified. They also they have expanding their product line. They're focused on. So I'm not going to go through all the numbers, but I want to go through. Oh, we bought the stock 2016. We bought like right about here. So this is we caught this stock right when it was going up. Let's see. Okay, these are their growth strategies, and generating their focus is on cash flow. So that's their number one focus, and that's their long-term growth strategies. So John, remember you were asking where do I find out where strategies are? So my suggestion would be to look at their investor presentations and as well as listening to the earnings calls. Let's see. Oh, this is one of the slides that I thought was for this company is that they're focused on two main segments, the flight support group and electronic technologies group. So the flight support group is on airplanes, while the electronic technologies group is on airplanes and other aviation. So let's see. Okay, so this is the flight support group, is the parts, repairs, specialty projects, distribution. Matt had asked a question about the impact of the Boeing MAX. And since Heiko specializes in flight support with these parts and repairs, they didn't say directly that they would benefit from the MAX, the 737 MAX not being sold because of companies needing to repair their existing planes or replacing parts, but they kind of briefly ran across the top with that they were that part of their product line was especially strong. Let's see. This is one of the things I wanted to show you, is that this is their parts that they provide to the airplanes. This is their global network of customers, all these different airlines. This is the electronic technologies group, and very quickly, these are their products that they manage, and then these are the different aircraft. So the Boeing 737NG is the generation before the Boeing 737 MAX. So that's one of their programs. So they missed that whole MAX introduction, and probably because it's too new of a line for them to have all the repairs and parts for that. Let's see. Okay, so that's, oh, and this is more their customers. So they're very well diversified internationally and with their different clients. Okay, so this is the value line. Their 5-year projections for annual return is fairly low, 2% to 12%. We've done really well with this stock, as we saw with Tom's when he was showing how well it's done in our portfolio. It's not in a sell range right now. It's actually in a hold, so that could be a discussion. I know Hanny says 5 is in a hold. I'm not sure, how long we actually hold on to a stock if the projected return isn't going to be, I guess, like our target, 15%. Let's see. So real quick, I did the annual report form. Our original purchase price was $42.92, although I couldn't find that. When I researched our Yahoo Finance, it said it was $34.58 at close. So like Hanny was saying, Yahoo Finance provides a daily update on the price. So I'm not sure if the date is wrong or the actual purchase price. But so the closing price as of the date that I took this was $119. It does fluctuate. Let's see, during that, when they did that a drone attack on Soleimani, all the defense stocks went up, with probably anticipating some kind of conflict. So anytime there's any kind of headwinds or about conflict, then defense stocks will go up. I'm not sure if Air Lease went up, but HEICO it was mentioned in that article, but it wasn't one of the primary stocks to be affected by that. Let's see. The current PE ratio is really high. So what I learned from Jay is when the current PE ratio is higher than the average, there's not a lot of room for expansion. So it's pretty much, people have invested in HEICO, and I don't know if there's a lot more room to grow. Let's see, I think, they're really into doing acquisitions, so they've acquired, that's one of their ways to grow. Let's see. So, okay, so the recommended is a hold for the SSG, and the buy is at 93. So unless something happens with the stock for it to lower, we won't be buying more of it, but I guess we can continue to hold. And let's see. This is the SSG. So this is a nice looking SSG. I didn't change any of Roy's forecasts. The pre-tax profit, return on equity, debt to capital, they all look good. This does have a dividend, but as you can see, the upside down ratio is 1.2 to 1.
No,
Let's see. Go ahead.
I have a question about your projected growth rates.
Okay.
On the front page.
Okay. Okay.
I'm just wondering, I know you said you left them, but it just somehow, 8% for sales and 14% for EPS doesn't quite jive unless they can really expand their margins.
Yeah, I know you bring that up, Tom, and I've always learned with this SSG that earnings follow sales. So when I usually do a projection, my earnings are in line with sales. So when there's my understanding also is that when earnings is higher than sales, that's when they're in a high growth pattern. Is that your understanding? When would there be a significantly higher EPS compared to sales?
Well, if their margins expand, if they can decrease the operating expenses or decrease cost of goods sold or whatever, like they're only, like say their margin is 30%, for every $100 they're bringing in $30 worth of profit, and I mean if their expenses go down or something, they could bring in $35 or $40, but in order to keep bringing in more profits with the same amount of sales, you have to decrease expenses somehow.
But if you look at like that's a good point. But look at 2010 and look at, so the green line is your sales and the blue line is earnings per share, and the gap is essentially your cost. So as time goes on, it looks like the blue line is moving closer and closer to the green line, which means that they're reducing their costs. And
it looks like 17's an outlier. That's probably taxes.
So yeah, but even 19 is a little bit higher than 17. So it looks like they're doing something to reduce cost a little bit. Now, how long can they do that for is a good question. Can they keep reducing cost over the next 5 years? I don't know. I don't have a gauge. But
if you look at percent pre-tax profit on sales, it's increased a little bit, maybe 2% over the last 5 years.
So would you
top line there, evaluate management?
So my strategy is usually to have the earnings follow sales. So if I put in 8% for earnings, would that be more in line with?
Well, you could try that. What's does value line say?
On this the analyst consensus here on this SSG is 7 and 16, which is pretty wild. What are they saying?
Earnings is 14 and a half and
14. 8. Yeah, that's pretty much what the value line says. Well, okay. It just seems
they must be doing something to reduce their costs.
Seems difficult to achieve to me, but okay.
And their debt is not too bad. At a 5-year average of 30%. That's for a company that is into that line of business. That seems like a reasonable amount of debt. But Joanne, are you talking? So we can't hear you.
I'm seeing a microphone there, some down there in the middle.
Oh, she lost her sound.
Oh, can you hear me now?
Oh, yes.
Yes.
Yeah.
Okay. I pressed my little button on my headset. Okay. Yeah, let's take a look at the quarterly data. The percent change on the year over year, it seems like it's going down, so we're staying flat, relatively flat.
Can you show the graph, the quarterly data graphic? Just get a bit of a visual. Yeah. So the quarterly earnings are dropping from a high in 2018, and then sales are, well, they went up, I guess, in the last while, but they're, so they're relatively flat, like you say. In fact, it looks like they've gone down a little bit. 2019, 07, and 10.
Yeah.
Okay.
There's something strange going on, I mean, for a couple months there, it really shot up. I mean, a couple quarters.
Yeah, I don't know about the earn. I'd be interested to learn what changes earnings. I mean, because like right here, following this kind of trajectory here, they are relatively close, and then they separate. 718, 1018. Now they're kind of coming back together.
Well, these are kind of quarterly, so it's hard to gauge anything with that. I think it's just you want to just see the pattern, but it's the annual. It's kind of
could be some one-time gains in there for some reason. I don't know if they sold some. Like the home builder I was talking about. They sold something in a particular quarter. So this. You don't know unless you dig through all the reports.
Yeah. Okay. Ratios. So relative value, it's like I think when it's 100%, well, if it's below 100%, it's a good opportunity to buy. And when it's over 100%, it means that people have a lot of confidence and are buying this stock, but it might be overvalued. Okay. Let's see. Just check this. Okay. Are there any other questions?
So what's the recommendation? To hold or to hold? Okay.
Based on the SSG.
Okay.
Okay. Let's see. I want to see what's next. Well, you're next, Hanny.
Yes.
Okay. All right.
So I guess I can.
You want me to make you the presenter?
Sure, please. Thank you.
Okay, hold on.
Okay. Can everybody see my screen? Okay. So just for the sake of people on the call that may not know, Five is a discount sort of retailer in the United States. They're not in Canada yet. They sell to teens mostly. And the reason they're called Five is everything in the store is $5 or less, although they have some $10 items now. But they're basically like a dollar store, but for teens, and they have really cool things that teens and tweens would be interested in. And one of the strengths of this company is that they identify products that are going to be attractive to their demographic, and will sell. And so that brings in a lot of foot traffic, and because the products, they have a good sort of handle on which products to buy. They've been doing really well, and the stock has been shooting up significantly. We've done very well with this stock. So I'll give you the bottom line. The SSG says hold, and I think we should sell. And we can debate the numbers and which PEs I used and so on and so forth, but those are all sort of mechanics. And what I try to do with some of these is get sort of the story behind it, and what is it that that would support that recommendation. So one of the things, you can see the growth rate in sales. It's been going up pretty dramatically, and but you can see here that the earnings are starting to flatten out. The other thing to note is if you look at the pre-tax profit, again, it's been going up, and then all of a sudden it kind of, if you look at from 2014 to 2018, it's pretty flat. It's like 11, to 12. The average is 11.7. So say 12% for argument's sake. So that seems to be a ceiling that they've hit in terms of their pre-tax profit. Now, if you keep growing, and their strategy, their growth strategy is that they're in certain states and certain markets, but they still have a ways to go. And so their objective is to open about 20% of their existing store footprint. So if they, I think they have about 1,000 stores or close to it. And so next year they would open up 200 stores, and the year after that they would be 20% of 12, which is 240, and so on and so forth. And that's why when you look at the historic sales, you see a pretty steep growth curve, because they're growing by opening all these new stores. The other thing is that you have to look at with a retailer is what's called same store sales. So if I have a store down the street and I keep going into that store, am I buying more each year, or collectively as customers that go to that store, or am I buying the same amount? So you want to see the organic growth or same store sales increase. And their same store sales were about 2 point something percent, 2.5. But again, if you open new stores in a new area, there's a lot of excitement around store openings, and so you should see a higher return on your investment, and more profit on sales when you go into a new market, because there's a lot of hype around it. I remember about, I don't know, 10 or 12 years ago, we had Krispy Kreme was coming to Canada, and you should have seen the lineups. People were lined up for literally for a mile around the block to get a box of Krispy Kreme donuts.
Here too, yeah, in America too. I remember
except that lasted for all of about maybe 3 months, and now all of the Krispy Kreme stores in Canada have pretty much disappeared, with the exception of 1 or 2. So when you get this, new stores opening up, you would expect to see a lot more profit and more growth in earnings. If we go and look at the quarterly data, you could see the earnings are dropping like a rock. And then if you look at the PE here, it's at 44, and the average is 33. And if we look at, say, take just a comparison, it's not the same, but it makes the point. If you look at a retailer like Macy's, they're trading around I think less than 9 PE, and Home Depot I think is around 20, and it's a very strong company, great balance sheet. So I think that as time goes on, when they open these stores, there's a lot of headwinds. They have to now, they're going into new areas. They have to build more distribution centers. You have the trade war with China. A lot of their stuff is made in China, and if there's a tax or import duties on the Chinese goods that they import, they don't have a lot of flexibility in terms of suppliers. Most of their suppliers are coming from China. So if there's tariffs on Chinese goods, they're going to have a big issue. So I think as they are getting bigger, they're starting to see more costs in the business with these distribution centers. They're kind of leveling out in their existing markets. They're not seeing a lot of tremendous growth, and and you could see on back here, their pre-tax profit it's pretty much leveled out. And at a 44 PE, for a retailer, like they better be seeing a lot more earnings growth. And if they can't generate, that level of earnings growth, then their stock price is going to suffer tremendously. So I think it would be good to get out while we made a profit on this company, and then look for something else that is, that's a bit, better growth prospects. Something like this was when we first bought it.
So Hanny, did you catch their last earnings release?
Yes, I did.
Because there was their stock price fell a lot and then it bounced back some. There was some negative news. I don't remember what it was.
Yeah, it was just some of the things that I mentioned, like they're having to build more distribution centers, and that's eating into their earnings. They didn't see as much growth in earnings as people thought they would at a PE of 44 for a retailer. It better be significantly higher than what it is. It was good. It wasn't that they didn't report good numbers or that numbers didn't meet expectations, but I think people were expecting a lot more given the valuation. So I think the price is pretty rich right now, and it's doubtful if they can maintain that earnings growth.
Okay, thanks.
You could see the thing that really did it for me was, look at how much this is dropping, quarter after quarter.
Oh, for sure.
Yep.
Do you think some of the trade war relief will maybe boost the earnings back up again, since they have a deal now or whatever I hear in the news?
Yeah, so there's a lot of mixed feelings about, or mixed opinions about this phase one agreement. A lot of people are saying that China can't. So I think there was some conditions that China has to buy so much agricultural products from the U.S. and I think a lot of that is noise. The real sticking point is IP theft. And we've seen that in our business with, we have an office in China, and we've seen the IP is a big deal for us because we develop our own IP. So I think that's really the end game. It would be nice if the balance of trade was a little bit more balanced. But I think you're going into an election in the United States, and I think people are looking for some good news for Trump. But I don't know how. I think you'll still see tariffs.
Yeah, I think the tariffs are still on. They committed, or they said that based on market conditions, they were going to buy this huge amount of grain. And from analysts I heard, they didn't even know where all that was going to come from. The number's so large.
Yeah, right. I guess I just meant more is the earnings decreasing temporary or permanent.
But I think the tariffs are still on. I don't think they've been dropped.
Well, they're still on, and there's some that haven't even kicked in yet. So there are some that are still coming that haven't kicked in yet. So that's where these guys, I think, will be impacted the most.
But do you expect them like long term? Like once Trump's gone?
I don't know, but I think that, and I'm speaking as a Canadian, so take everything I say with a grain of salt. But I think that this IP thing is really hurting a lot of people, not just in the United States, but in other countries as well. And I think that what Trump did was he sort of catalyzed, the movement against China with respect to IP. And so I think even if he's gone, I think whoever comes in after will not let up. I think people are keep pushing this, and there's a huge, tug of war going on between the United States and China as to who's going to innovate more and be the world leader in technology. And if people are stealing IP, then that's a big deal. So I think the pressure will continue. Whether Trump is in power or not. That's my 2 cents. But I'm just I'm not an
Hey,
Yeah,
do
fair.
we have, if we sell, do we have a candidate to purchase to replace this?
No, I don't. I didn't get into that, Bernard.
Okay, pathetic, yeah.
I was looking
Okay,
the
thank you.
CNBC last Tuesday. We talk about this company, Five Below. Actually, it was the worst performance ever since 2015, plummeted 11%. And on Tuesday, the company gave guidance for the fourth quarter, and the consensus was also kind of optimistic. So the stock went up about 2% on Tuesday morning. So I kind of do agree with Henny. And look at the trend for 2 years, right? Almost 2 years, it's going down for the earnings. And then and also the sales is kind of flat. Maybe we should take a profit. Another thing is,
Can you scroll down a little bit? Sorry, I just can't see that.
that's okay. Scroll down.
I
Okay, can I interrupt just a second? We're at 7:30. Should we skip the education topic?
Yeah, I think so.
Okay.
Definitely.
All right, we'll do that next time.
I guess he meant scroll down to see the quarterly data.
Yeah, just to see the more recent data.
Okay. Yeah, I'm just looking at this graph tells the story of the sales flat and the earnings going down, right? And another thing, what I'm thinking myself is buying habit. I won't let my daughter to buy anything plastic anymore. So this is below 5. I just felt like personally, because environment issues that people much more aware of, the environment, the plastic. I felt like it could also affect their sales. It may
Yeah,
not.
that's a good point, because I never thought of that, but I would say, and I'm just throwing out a number, but I would say 80% of the stuff that they sell is plastic. It's really junky stuff.
Yeah, for kids, they do like those little things. Because my daughter, I can speak for her. Her friend's house, full room of a plastic junk, full room of it. And so, as I can see, it may, that helps below companies like a below 5, right? Dollar store, or wherever. But for my personal purchase habit, I probably will not go to that store. Used to, I thought. I think we should take the profit. The profit.
It's not the
agree
kids
with
that
you.
are making these decisions, probably, right? It's their parents. So.
Right. We have a nice profit. We kind of we own this for 4 years. We bought this 2016, and we have gained about 150%. I think it's nice profit. We should just take and run and buy something else.
Is there anything that's growing like this that we could buy in the retail space? I mean, this is great numbers. Like, the return on equity is amazing from this company. 30% almost with no debt. And they're selling basically trash to people for money. I mean, it's a pretty good business, I guess, is what I'm trying to say. I don't want to just give up on it right away,
That's why I never bought it, but I wish I had.
But you look at the fundamentals.
I know, right?
But Matt, look at the fundamentals.
Yeah,
just
go back.
Sales earnings, they are not there anymore.
They're growing 20% earnings growth, trailing 12 months.
No, look at the
trend. 19.7?
No, look at the trend though.
Look at the trend.
I understand the trend. I mean, but come on, 55% growth is that was a little I don't think it's going to last forever, right? I mean, it would be great, I think, but
at a PE of 44 for a retailer, right?
Yeah.
It's a retail operation, and when I compare this to Home Depot or whatever, I think the reason this company did so well is because they came out of nowhere. They had very few stores and they were growing like mad, and people took notice of that and said, wow, this is a tremendous growth story. But as we know, once you hit a certain size, and their strategy is to put stores everywhere. So if you're trying to grow 20% of your store footprint every single year, that's a logistics nightmare. Like how do you get product to all these stores? And now they might be able to do it, but I just think that when your stock price goes that high, people have certain expectations, and if you don't meet those expectations, and if your earnings start to go down, then people will start bailing, and so the stock is going to take a massive hit at some point. It may not be within the next 6 months, it may not be next year, but I think it's I don't know. I
guess even at the price earnings ratio, that is really high. But if you look at the PEG ratio, it's about 2.
I want to go back to focus.
That's not even the worst one of the companies we own.
Are they still a medium-sized company, or they're a large company?
Probably go back to the first page.
I think they're kind of small.
When we bought it, it was very small.
Yeah.
And we bought 2016 was like 1 billion. Now it's 1.5. Wait, no.
800
million.
And now it's doubled.
Yeah, it's doubled. So, couple things, Henny. First, go ahead, Megumi.
As the company grows, though, we expect their growth rate to slow, right? Or is that happening to Five? I personally have a problem with cheap junk, plastic junk. So I think we should take our profits and run. But I'm wondering, like I said, as a company gets bigger, we expect the growth rate to drop. So is that what's happening to Five, or no?
That's why I want to look at the fundamentals. Yeah, look at the fundamentals.
Look at pre-tax profit on sales. It's leveled out, and then as they build more stores, their costs are going to go up because they have more logistics. They have to the way that these guys work is they're going to build a distribution center somewhere, and then those 200 new stores that they opened, they're going to have to deliver product to those new 100 stores from that distribution center, and those distribution centers are expensive. So as they grow, I think their expense number is going to go up, and they're not seeing the sort of the early level of growth that they had when they first started. So they're starting to taper off. So I'm just saying, like, I agree, Matt. Like, you have a return on equity. The average is like 28%, which is very, very decent. But if you look at the projected growth rate, if you look at the value line, and let me see if I can.
Just a second. So when we talk about return on equity for this company, this industry, what is this industry's return on equity? So what is General Dollar Store's return on equity? So we need to compare. The 28%, maybe it is that industry's return on equity.
Yeah, that's a good point.
You could click on compare peers and it would show.
I don't know if it.
Also, Henny, you need to refresh the price. Your price is for January 10th, so a little bit old.
Right. Okay, where's first of all? Data, refresh, create copy, refresh data, hit F5.
Yeah, no, oops.
You need to do it again.
Do it again. Yeah, no.
Where's data? Here.
Data.
116.
Went down.
Yeah.
Dropped. So now we look at the peers.
Compare peers.
Just curious. Like we should put the general store, general dollar, what's it called?
DG.
Dollar General.
DG.
Dollar General is DG.
Dollar General. Okay.
But for the industry, it shouldn't matter, right? Isn't
No
that what we
industry.
were
We
saying last
won't
time?
look we want to compare with Dollar General because they also like a cheap store sort of thing. Oh, put a
Mm.
Target too. Just curious. Target or Walmart. Man, do you still have a Target? I remember first time.
Yeah,
You
it
still
did
have
really
that.
good this year.
Okay. I'm just curious. Just put Target.
TGT is, there we go.
Yeah. Okay. Let's see. What are we talking about? Return equity? Okay, let's take a look at return equity. See that? Well, below 5 is still a bit higher. I don't know what happened to Dollar Store. Well, 2017.
Wow, Dollar Tree's bad.
Yeah. We don't know what happened to Dollar Tree. So look like it's this industries just about, right? 26%, 25, 26.
It looks
Yeah,
like they're the best one in the industry. Is that what you mean?
Yeah, because they're smaller, right?
Yeah, so do you have to compare small to small, medium to medium, large to
Well, you're
large?
comparing it like I
No.
guess the target,
No?
but
Okay,
the overall
that was the
industry.
question. Yeah.
Overall industry. Yeah, I'm just saying as an industry, it's about 25, around a 25. So it is, sure, below 5, 2018 is great, 28%, right? So, but I'm just saying, it's in this type of a store, this type of industry, they are return equity. It is in that area.
It's the best. Is that what you mean?
Well, but
I'm not sure if it's the best. Is it the best? 2018? Okay, yeah, sure.
According to
2018
this,
is best.
yes.
it's not like it's way,
significant.
it's not like it's 30 and all the other ones are 10, I
Right.
mean, they're all in
Well,
a,
that's true,
in a
but-
range there.
Yeah. No,
But if we're going to replace
Below-
it with something, I guess I'm struggling with what we're going to replace with. You know
well,
what I mean?
5 below, it is, I
Good
have to
point.
agree that 5 below, it is well-managed company. But what I'm looking at the trend in the last, 2 years, I felt that the earnings is dropping, it's trending down continuously. And the sales is flat across. That's why I kind of agree with Henny. Maybe we should just, find something else.
But if we keep it as cash, it's not gonna, maybe we should find something first.
Well, see, I have a big I disagree a lot with that argument, and a lot of people bring it up and they say, well, if we put it in, so Warren Buffett is sitting on $160 billion of cash right now because he can't find anything to buy that's value, and I'd rather have cash than lose 20 or 30% of a portfolio or of a particular stock. So I think yeah, if this was and I'm not, I think if there's an alternative, then definitely we should not be putting things in cash. But I think as a defensive thing, there's nothing wrong with putting things in cash until you find something better to buy, and then you buy it, and then you don't lose money.
Yeah.
One of the key things is to preserve capital, because if you're down 20%, you have to come back up another 20% just to break even. And if it takes you, say, 2 years to get back to break even, you haven't grown in those 2 years. So not only did you lose 20%, took you 2 years, you've lost that 2 years of growth. So it's not a bad thing to be sitting in cash and earn whatever 1.5% if that protects your downside.
20% fall from what? From our original purchase price or from today?
No, from today. I'm just using that as an example, right? Because I think there's a lot of people right now that are saying, this bull run is going to go on forever. And I think within the next you know, I don't know. I don't have a crystal ball, but I think we're gonna hit a downturn pretty soon at some point. So there's nothing wrong with protecting what you've built and just,
no, I think we should sell, but I'm just playing the devil's advocate.
I have another question, Hanny. Is this a buy right now because the price dropped significantly? Is this right now a buy? Is a hold?
Well, again, like I don't go by what the SSG.
Right, I know. Based on your assets right now, what is?
It's a hold.
Oh, it's a hold.
Yeah, it's been a hold. It's been a hold forever, and I have been wondering what.
Okay. Reason why I'm asking because it sounds like to me that Matt likes this company, and I was wondering if Matt you buy it. I mean, but it's not.
Here's the other.
Mainly because I buy other retail, but.
Here's the other thing, right? Is that, you know, again, we're an educational club, so if we want to hold on to this and see what happens, there's nothing wrong with that because we're not playing with real money.
No.
If people are holding this in their portfolio, I'd be, if I was holding it, I'd be concerned.
I will not using that mentality. We shouldn't have that mentality. Oh, because we have a virtual money, we shouldn't think it that way. Honestly, this is some decision
some of us own the stock. So.
Yeah.
I own that stock.
Yeah. Then I can't. I will not give you advice. I'm just saying.
No. I already made my mind.
Did you sell it, Jay?
What? What did you say?
Did you sell it?
I will sell. I will. I just looked at my. Actually, I bought this for my husband's retirement account. I'm going to take the profit.
Yeah.
Okay. Remember, when you sell it and you take the profit, you automatically lose 20% because you have to pay capital gains tax.
It's in retirement account.
No, it's in my retirement account. I don't pay tax at all.
Yeah.
Oh, well, geez, come on. You're cheating. You're loopholes.
Can we go to value line? I had a quick question on value line from two stocks, but my mic was off and I couldn't. So on value line's projections, this 22 to 24, what does that mean exactly?
Sorry, where do you see the 22?
Left column, like for 22 to 24 projections, 2022 to 2020. That's 2 years away. 2022 to 2024. Left column.
I'm not sure. Oh, here. Yeah.
Yeah.
So they always give a range. So it's actually so this is actually 2024. It's 4 years away, but it's 2 to 4 years, right? So it's 2, 3, or 4 years away. And the value line doesn't. So what you have to do, like if you take, and there's a good, Ann Cunhas did a really good webinar on value line. So if you take these sales numbers here,
yep.
You see where it says sales, cash flow, earnings. So it's 17.5 in sales, and earnings is 18%, and that's from 2016 to 2018 to 22 to 24. So like from 16 to 22 is 6 years. So what they do is they actually take an average of 16, 17, and 18. So if you go up here and you average out these 3 sales years, and then if you want to project, say, 3 years into the future, then take this growth number, 17.5, and apply it to that average for 3 years in a row, and that'll give you a 3-year number. If you want to apply it to 4 years, then do it for 4 years.
Okay, so if you go to the top of the page on the left column,
the top on the left.
Top left, there's those projections.
Yes.
What are
so that's what they think the stock price will be between 2022 to 2024. At the low end, the stock is sitting at 131.84 right now, according to the value line thing, whenever this report was done, right? And it tells you at the bottom. So this report was done October 25th, 2019. Okay. So what they were saying at that point in time, they're saying, you know, two to 3 years from now, this stock could be sitting at 130 or it could be as high as 190.
But I guess what's the significance of projecting 2 to 4 years out? Why not next 2 years? Why?
That's what they do a long a term model, right? So they'll actually take the financial statements and they'll model them out for for 2 to 4 years. In some other cases, they do 3 to 5. And,
I have to break in. We have 10.
Yeah.
We have 10 minutes. 10 minutes.
Yeah.
So
I wonder how accurate they've been. Just curious. Anyway, thank you.
So we need to wrap up and vote if we need to vote.
Yeah, I guess we should do motions, right?
so I'd like to make a motion to sell 5.
I'll second it.
Okay.
Okay. Everybody use their My iClub. Fanny, are you going to set that up for us?
Sure. Okay. Let me.
Now, will it appear?
well,
I
Hanny's
clicked on voting, so will it appear in the voting under the voting
No,
tab?
you have to log on to myiclub.com.
I am logged on to my club.
Okay, and click on voting.
Okay.
Jesus.
As Henny set up, can I show you guys LGI Homes, what I found as he's setting up to save
Okay.
some time? Okay.
Make yourself presenter.
Okay. I'm still reading what's going on in 2019. They are releasing their annual report end of February. But what I'm looking for is this their latest presentation talking about what they do. Actually, they have some very well recognition. They IPO'd in 2003, and they are 2010. They started doing joint venture. I don't know who GTIS is, but that's their strategy. And also 2013 they went to IPO, and 2016 they were named as the builder of the year. I thought that was pretty cool.
Oh, they turned renters into buyers. That's interesting.
Oh yeah,
Where?
we talked about that before, I think, or I heard that. So you rent, and then part of your rent goes towards building a down payment, sort of.
Well,
then,
rent to own.
Yeah, rent to own. Yeah, basically.
Oh, interesting.
So speak of a down payment, this company, one thing they do is that you don't have to pay down payment, 0% down payment. That makes me nervous, actually, honestly, because that reminded me of 2009, everything like a 0% down payment. But anyway, they talk about on their website that you can do 0% down payment. So 2016, 2019, they were voted to be the top 10 among the 100. So at least they have some sort of a recognition. And then another thing is that's the geographic diversification. As you can see, mostly their business is in the central and what's yellow?
Southeast.
Southeast.
Yeah.
Yeah. In their second quarter, they mentioned about Sacramento. They're building house in Sacramento. I think John mentioned that too. So looking at they are goal, wholesale organic growth is to expand existing recently entered markets. I don't know what that means. Selective expansion into new markets. I don't know what that means. Those are like a buzzwords to me.
Did everyone
Wholesale
vote?
and
Oh,
they do
I
acquisition.
can't get to the.
Yeah. So the homes look like not very. It's just toward.
Joanne,
like
can you vote?
Let's see.
Jane. Sorry, I don't think Jane's
Jane's not
here.
here. Jane's not here. Jane said that she cannot make it. So
She's
look at
skiing.
there.
Is Mina here?
No.
Bernard, Megumi.
I vote.
Bernard, you voted?
I voted.
I have
He
not
said he
voted.
No, I can't.
Okay, I'll send you another email, Bernard. You
No,
should-
aren't we using my iClub?
You can do either
Can you
one.
Let
vote?
me just vote orally. I'll vote yes, sell all the goddamn 5, under 5.
And by pot.
Well,
That's
maybe.
that's coming next month.
Okay.
Oh, and Tom,
What?
I looked at the archived motions and we sold PSA 1118.
Okay, I'll take care of that.
Okay, thank you.
Oh, one thing I like this company that
Jay,
they
you
pay
gotta
their
vote.
pay employees that every week they may mention something about full-time CM. What's the CM? Construction manager on site. We pay on
Yes.
time every time.
That doesn't
Sell
mean anything.
building. Oh,
Yeah,
that means
construction manager on site. Yeah,
It just adds cost to the project.
yeah.
Oh,
Jay, you
if-
need to vote.
Oh, okay. You know
Is
what my
Mina-
vote is.
Is Mina here?
Nina's not here.
Okay.
Okay, voted.
I think once you vote, we'll have a majority.
Yes,
Really.
I voted.
think we already have one actually, but
They don't do options.
No,
Yeah.
So
don't. We can't tell. We need Bernard to vote and the system for it to flip over probably.
Say
Can
that
we
again?
eliminate Mina, Jane, and Roy from the vote to make it so it flips over easier?
I don't think so.
Okay.
Okay,
Should we take Roy out? Take
mm-hmm.
I didn't want to take him out because, but yeah, we should. But he
We
was
should.
sort of coming back in and out and stuff, and I didn't want to remove him, but I can do that.
We
But-
should because
but
the reason
now-
why he replied email because we forgot
we have
to
3
remove him.
minutes. 3 minutes.
We forgot to remove him from the
But
distribution
if
list.
Are there any other motions while we have time before the meeting's over?
I am very debating
Tom?
about this company, LGIH, LG Home, and so does the other one,
Lennar.
NR.
You know-
Yeah,
You know, I kind of like CVCO, Copco. They're home builders. They're automating home building. But I
we
sent
need
an
to
email
do a
to Tom, but I guess he
do a
didn't.
study before we can consider it.
yeah, we have to study.
Yeah, okay. Right. Okay.
Let's figure out
But I
this.
just meant
this
CVCO.
figure out this Five Below. There's I guess there's 9 of us here. We can't. It's divided enough that the system's not going to flip it over. So we need to do the roll call, I think, unless someone else has a better idea.
No, that's a good idea.
Yeah.
What was it?
Okay.
What was it? I didn't hear it.
Can you repeat
We're gonna have to
that?
sound off. We're gonna have to sound off, or else it's not going to get flipped over. It's not going to get flipped over, so we got to sound off.
I
Okay.
don't understand that. What does that mean?
What does that mean?
Um,
Yeah.
We say we're going to
Like-
vote.
Vote verbally
Yeah.
I
exactly.
vote
That's the easiest
What's the
way to
motion?
to sell 5.
I
Okay.
thought we
I
already
thought
did. Okay.
I'm
that
going to
was
go
better.
down through. I'm going to go down through the line, and then Hanny, will you tally it? Okay,
Sure.
Bernard. Yes or no?
Yes,
Bernard?
sell.
Hanny,
Sell.
All 5.
Jay,
Yes.
Joanne, yes. John,
No.
Matt.
Or John Catterson, no.
John Canderson. Matt,
I'm a no.
Megumi,
So
Tom.
So
So I have 6-2.
well, it carries.
Yeah.
Pretty close.
6-2.
Okay.
Yeah.
All right.
Oh.
Oh,
So
62. Sorry, I saw 64. I'm sorry.
we have 1
I
minute.
was,
We
I
have
was
1
thinking about
minute.
something else.
Is there anything else before we?
I was still debating about these two companies that John and Tom presented. I think, see, look at this company, the graph. It's not too bad. Up straight, not as below 5, that up straight parallel, but look at the overall trend. It's not that bad. But I hesitate to, I don't know, the projection. I'm not sure how conservative. I felt like it's, do you think a 13% is conservative?
You know,
It's a very small company, and I was not able to find this. I found Yahoo's gave about 15%, 14.83 next 5 years. And
you know, I'm thinking that they're not a good enough value to buy at this point. I think they are decent companies, and the market has just, the price has been driven up because of the way the market is, and then there's been good news in that industry, and I'm thinking this is not a great entry point.
So
Yeah,
does the
I
other
mean,
company. So does the
I
other
did.
one.
I think in October I did the same industry study, and that was sort of the same conclusion. A couple of them came out with good graphs and a buy, but we ended up not buying for, I can't remember why. But it's just super volatile.
Okay. Then can we adjourn the meeting, and if there's any discussion afterward, we can talk then. So next month is all quarterly reports and annual reports. There's not going to be a stock study.
Right.
Okay, I think we have 1, 2, 3, 4, 5, 6, 7, 8, 9 reports tomorrow, next month.
Let me make you a presenter so we can see
sorry.
where you're looking at it. Joanne.
Oh, I'm just looking at Matt's.
Oh, okay.
Yeah. Okay.
Okay.
Looks good.
Looks good. Okay, so meeting adjourned.
And then we go to our guests.
Yeah.
So
Okay,
what's
I'm going to
happening
stop
here
the.
now? Okay, so in March, I've got two. I've got Skyworks and Lamb. Okay.
Yeah. Okay, I'm stopping the recording.